Thank you for joining us today for our Market Outlook webinar. Today, we're talking about what could break the markets in 2026. Before we get started, we want to take a moment to remind everyone that nothing in this webinar should be considered investment advice. The information being provided here is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Any decisions you make based on this content are made at your own risk and discretion. Before making any investment decisions, it is strongly recommended that you consult with a qualified financial advisor or professional who can provide you with a tailored advice that is based on your own circumstances. For those of you who are less familiar, Capital Squared Financial specializes in retirement planning. We specifically work with individuals and families who are thinking about transitioning to or are in retirement. We also offer proactive tax planning, multi-generational planning, and each of our clients has an individualized investment strategy that matches their overall financial or retirement goals. We serve over 80 families across 13 states and currently manage over 190 million in assets. Our presenters today are Alex Seleznev and Asi De Silva. Alex is the founder and president of Capital Squared Financial. He specializes in helping people successfully transition into the next chapter of their life and enjoy their golden years. Asi is the chief investment officer and spent 25 years on Wall Street. He now enjoys working directly with clients and applies his global investing and experience knowledge to help shape investments and planning decisions around each client's unique retirement journey. Throughout this presentation, please feel free to add your questions in the Q&A section, and we'll get to them at the end. And with that, I'll hand it over to Alex.
Thank you, Alyssa. Of course, thank you everyone for joining us today. I very much hope you're staying safe and warm. Hopefully you're not impacted by the snowstorm too much, because we actually had a couple of clients who had to relocate temporarily. So hopefully, again, that's not your situation. So in terms of our seminar today, or webinar, I should say, of course, this is the very first one this year. And what I always try to do when we kind of put together the slides and, the materials, I try to come up with a theme that perhaps, describes where we are today. It doesn't necessarily always, exactly matches, but perhaps the theme for us to discuss today is the fact that we're at these, crossroads. And what I mean by that, if we look back at 2025, which turned out to be a positive year, at least for the markets, a rather turbulent one, but still positive. And then you go back to 2024 and even 2023, it's been quite a rally over the past couple of years. At the same time, if you look at the market turbulence, specifically in 2025, and you think about, perhaps what it would look like in 2026 and going forward, specifically over the next 3 years, then chances are certain things will persist. And as Nelson Mandela famously said, may your choices reflect your hopes and not your fears. Now, I'll tell you, after spending a lot of time talking with our clients last year, specifically in the beginning of the year, very frequently people think of it in reverse. So hopefully, again, we can change it at least somewhat after our webinar today. Now, just to kind of get us started, just to give you a big picture overview, and just like in the past, by the way, for those of you who attend our webinars, that's what I usually do in the beginning, and then Asi will really go into details and some of the most important ideas for you to know about. So last year we finished the third consecutive year of a bull market rally. Again, for those of you perhaps less familiar, bull market is when markets go up, and the bear market is when they go down. Now, this particular rally has been quite strong. So the S&P 500 index returned 88%, actually over 88% over the past 3 years. Now, I can tell you there's a number of clients, for, I would say, legitimate reasons, that wanted to compare this rally to what we had in the mid-90s. As perhaps many or even all of you recall, we had a really strong one between 1995 and 1999. The S&P was up by 228% back then, but then it resulted in a dot-com bubble which was, quite an event, let's put it this way. And at least from our perspective, again, we'll dive into that more. Perhaps it's not exactly that, in terms of what we know today, but there's certainly some signs. As an example, I would like to think that many of you are familiar with the term the Magnificent Seven. These are some of the top, tech and telecom companies. Well, as of today, they represent 35% of the U.S. market, or of the S&P 500 index, if you want to use that as a benchmark. Just just throw a number like that out there, but think about it this way. I know there are people out there who keep most of what they have in terms of their investments in this one index. So essentially, a third of your wealth in this particular example is concentrated in this top 7 companies. So one of the questions we'll try to at least partially address today, well, is this the time to consider other sectors? Of course, that depends on your personal circumstances, if you prefer to be more on a growth-oriented side or you need more income from your portfolio. But that's, again, one of the top considerations. So, but that's going to happen a bit. We'll talk about that a bit later. In terms of the title, of course, for our webinar, what could potentially break the markets in 2026? I can easily come up with a long list of issues, actually, but to keep it more digestible for you, we decided to split it in 3 broad categories: policy uncertainty, investor expectations, and market valuations. And depending on where you're coming from, perhaps one would be more important than the other. One thing I'll say before I dive into all of this, what happens in practice? Going back to the year 2020 when we had COVID, not that I necessarily want to remind people about it, or even the post quote unquote Liberation Day turbulence of last year. Usually it's the so-called exogenous event that people are not necessarily anticipating is what causes market turbulence. I mean, again, even going back to this whole tariff conversation, at the time, pretty much everyone was aware that our president has a certain, policy objective. It's just that when the actual proposed tariffs were unveiled, it took people by surprise, to put it gently. So in terms of the policy uncertainty, well, at this stage, it becomes somewhat undeniable that there's a pretty significant impact of social media on the markets, at least in the short term. And something tells me that you know exactly what I'm referring to. Our president very much likes, he's very active on his preferred platform, which is called Truth Social, and every so often there's a post, that moves the markets. Last year we actually had 13 of those posts that resulted in a market turbulence of at least over 1%. Now, in practice, though, at least what we know today, usually within a relatively short term, a week or so, those issues tend to, I'm going to say, resolve themselves. But again, it's undeniable that social media does impact the markets. There are, of course, geopolitical unknowns. I don't have to go far here. We're just, today's January 28th. We already had issues in Venezuela. There was the Greenland discussion. Now there's a situation in Iran, and it remains to be seen exactly where that's going to take us. Of course, the conflict between Ukraine and Russia, it's still there. Now it's in what was already hit the 4-year mark, essentially. So, those things, those regional conflicts specifically, they tend to have, some impact. I will say this, though, based on lots of historical data, they also tend to be somewhat, short term. Doesn't mean days, it can take months, but usually they don't necessarily change the narrative, so to speak. And of course, the midterm elections. I thought I would bring it up in the very beginning of the year. It's not necessarily a hot topic yet. It will likely become one, in the middle of the year or so. And I'm sure we'll talk about this more, maybe not in our next webinar, but the one after. But there will likely be some, market impact upcoming from that. Now, one of the it's actually a really good white paper read by from Michael Kitces here. It was analyzing the performance of the market of the S&P 500 index during the non-election years, presidential election years, and midterm election years. And what's interesting, as you can see on this slide, hopefully easily, well, on average at least, the performance in midterm election years tends to be the lowest. It's still in the positive, 8.6% on average, which is not too bad, but it's lower than in other types of years. Now, even though I'm sharing this with you, there are of course many other factors that impacts this. So I wouldn't necessarily come to any specific conclusion here. One thing to mention, and again, last year that was particularly apparent, well, don't let election years or politics in general, drive your investment decisions specifically. There's lots of research on the subject. Market performance is driven by corporate earnings, by economic fundamentals, not so much which party controls the House or Senate. Again, I understand it's hard for many people, especially those who are more involved in it, to think of it this way, but the impacts is just not as significant as people tend to think about them. Investor expectations. So this is something, by the way, is something that is very practical to us as a firm, because of course we work with our clients, directly. We meet with them, we talk about their concerns. And after, 3 years of this bull market rally, sometimes you sense that, the sky's the limit. Let's say someone invested aggressively over the past couple of years, their portfolio performed well. I can understand how, from this perspective of behavioral finance, it creates this illusion that you're essentially become invincible. The markets will just continue to go up and up. You just, buy the dip and you'll be perfectly fine. Now, and perhaps that's going to be the case. In some sense, I hope that will continue. But at the same time, the danger here is when people willfully disregard new information. It's available, it's on the surface, but there are lots of biases, again, back to behavioral finance, when people, again, tend to seek information that confirms their own assumptions about a certain position, about a certain market. You decide what that is, and they simply disregard what else is out there. Again, that's dangerous. Now, what came to mind, again, when I was preparing for this seminar, there are, of course, many great investors. Many of them published great books on the subject, and I will say I read many of them. But perhaps one of the somewhat less known investors, who's also still very active actually, his name is Howard Marks. And what's interesting about him, he takes a very different approach compared to someone like Warren Buffett, Peter Lynch, or again, other investors. From his perspective, investing is all about managing risk. And it's not to say that it's not important to have the right asset allocation, pick the right stocks, bonds, all of that is important. But to him, the driving force is risk management. So one of the quotes he has, if you expect more than the market can deliver, you're likely to take more risk than you realize. So when I first read it many years ago, it actually didn't make much sense, because it's not one of those, snippy quotes when it just kind of makes sense at the same time. But if you really think about it, again, in the context of the bull rally that we've been experiencing, well, there are these high expectations. And when the expectations are high, it's challenging for people to really assess the level of risk. So there's a good possibility that, people are taking more risk than they can handle, which will eventually lead to disappointments. So that, to me, again, is an important idea to keep in mind, specifically today. Market valuations. So talking about things that are somewhat undeniable and they're on the surface, and we just need to be considering them. So for the S&P 500, the current price to earnings, or PE ratio, is right around 31. Now, again, I know perhaps not everyone is into technical details here. So to explain it in simple terms, what a PE ratio means, price to earnings, essentially that is how much you pay today for $1 in earnings in the future. So when it's 31, that means that you pay $31 today to receive, $1 in earnings in the future from company X, Y, and Z. Now, the historic average, again, there are different variations of it, but it's right around 18. So as of today, we're 65% above the historic average. Is this news? Not really. That's been the case for some time now, including last year and the year before. So what could potentially happen here, there are two options, perhaps more options, as Asi and I like to discuss. Perhaps the earnings will continue to go up, right? So the E will go up and the ratio will go down. Or perhaps the prices will go down, so that will normalize the ratio here. Or perhaps both things will happen at the same time, meaning earnings continue to go up, but the prices still go down. Why would that be the case? Because again, we're operating in this environment of high expectations. And there are certain companies, I don't necessarily want to name them in this public webinar, that are expected to just double, sometimes even quadruple their earnings, almost perpetually. And chances are at some point they will begin to slow down. Doesn't mean they'll go out of business or anything like that, but at some point, pretty much every company will slow down. Now, this colorful chart here, and you don't necessarily need to study it, but I thought it would be interesting in kind of, the point I'm trying to make. Essentially, it shows you the performance of different sectors in the S&P 500 index from 2011 all the way to 2025. Perhaps you have some familiarity. There's technology, consumer discretionary. These are some of the more aggressive sectors. More conservative ones would include consumer defensive stocks, utilities. So in the long run, you would usually expect more growth-oriented to perform better. It's not always the case, but perhaps one of the expectations. If you study just the top right corner of this chart, what you would notice is that information technology, INFT, and telecoms, TELS, is that's how it's noted here. They've been the top performance over the past 3 consecutive years. If you go back, again, it's not always the case. So back to my earlier point, again, if you have those winners, and chances are you do have at least a certain allocation in those stocks, well, what makes us think that they'll continue to perform at the same high rates? From our perspective, we're trying to diversify, take some gains off the table without necessarily, I'm not saying we need to be buying bonds or moving into cash necessarily, healthcare, financial stocks, industrial stocks as an example. They've been supported quite a bit by the current administration's policies. They can be a good potential alternative. Now, just to make it clear, for those of you who know me, been working with me for some time, I always try to keep it balanced. It's certainly not all gloom and doom. Let's just make it clear. Now, there's this study by Morningstar, and I was at least partially surprised by it, but kind of confirms certain assumptions. Well, according to this study, there's a 73% chance of positive performance even after the third year of the bull market rally. And again, as I mentioned earlier, 2025 marked the 3rd consecutive year of double-digit returns. Well, that actually happened 4 times since 1949, and the median gain for a typical 3-year rally is 155%. So if you just want to disregard everything I just said, then you want to focus only on statistics, well, the current rally of 88% or so over the past 3 years perhaps still has some room to run. So just to kind of add a positive comment here. So to sum up, my thoughts here, again, in terms of the investor behavior, we are this crossroads. There's a possibility that perhaps due to your personal circumstances or your professional circumstances, especially in the DMV area, or your personal views, you missed out on the rally in 2025. Usually a more common situation is when people actually underinvest. They have a certain amount of investments, but they keep too much in cash. Well, what would you do now? because it's always forward looking, should you be chasing the markets, investing aggressively, investing all at once, investing in the winners of 2025 and prior years? Well, I would pause there and again give it more of a thought. Now, separate approach here, and we actually discussed it a couple of times with our clients last year. Well, what if you just wait until the next market drop and then you unload all of that cash that you have? Well, technically speaking, that could be a great choice, but there's some obvious issues. We don't really know when that's going to happen, so that's a market timing. And even if somehow, some way you predict that correctly, usually it's very challenging for people to actually implement it. So I would. It's not likely that I would recommend that type of approach. What if your portfolio performed well in 2025? Well, remember, we usually say it for compliance purposes, but past performance is not indicative of future results. So the fact that certain, let's say, a relatively small number of stocks performed exceedingly well over the past number of years doesn't imply that will continue. So, what would be the most prudent approach here? We'll consider rebalancing. Consider taking some gains off the table. Consider looking at sectors that are still growth oriented. Again, I'm not saying you should just become more conservative than you need to, but perhaps they don't have those types of high valuations. In terms of my key takeaways before we get to Asi's slides, well, as a reminder, everyone, the next market shock is just around the corner. And I'm not trying to be, I'm not trying to scare everyone. This is not about being pessimistic or anything like that. This is just how the markets work. They're inherently volatile. Now, I'll tell you, for a good number of our clients, especially after working with them for some cases for over a decade, actually, there's this mindset shift. Think of market turbulence as an opportunity. Understanding that it's not always easy to take advantage of that opportunity, but it's an opportunity. Think of calmer markets, as the time to prepare. That's not the time to just, fall asleep at the wheel. You're comfortable and that's that. You see, that's really the psychology you need to be successful at it. And of course, you can always delegate it to someone else. Resist the urge to make emotional decisions. Something tells me, again, what I'm referring to in the context of 2025. We will likely be in this environment for the next, 3 years. Things will likely happen, things that will make you feel uncomfortable, but there's a strong possibility that they should not impact your investment strategy, at least not immediately. Run it by someone else, make sure you make it the most prudent choice. And then finally, let's say you've been successful, everything is working great for you, over the past number of years. You still need to adjust your portfolio based on the actual market conditions. I don't necessarily want to repeat myself, but the winners of yesterday doesn't necessarily mean that they'll be the winners of tomorrow. So you do need to pay attention to that.